Hi, this is Adam Khoo here. It's the 25th of April. Let me just double check. Yeah, and we just entered the weekend. So preparing for the week ahead, let's look at the markets right now. So I'm sure you've been watching my previous videos where I called the bottom in the market and I called the bull run somewhere in early April. So the bull run continues, but for the last week, we have kind of been like going a bit sideways over here, finding resistance at the 50 moving average. Okay, so I've mentioned before that the market always goes up eventually, thanks to the Federal Reserve, and the crisis will eventually be over. Eventually, right? So we know that in the long run, we're going to go high and make new highs and make a lot of money. But in the short term, it could still go down temporarily, like I mentioned in my last video, before reversing and going higher, or it could simply just be a V-shaped recovery, never goes down, goes all the way back up. So I've got many people asking questions. Adam, right now it is here consolidating. Do you think it's going to break downwards, or it's going to just break above that? And the answer is I really don't know, right? It's a 50-50 guess, you can toss a coin. But the point I'm making in this video is it doesn't matter, right? As professional investors and traders, when you use the right tools and strategies, we make money regardless of short-term direction. So today I'm going to share with you a very powerful strategy that I use known as Snipex. Now, this strategy is something you can't learn anywhere else because it was invented by my very good friend Bang Pham Van, who's an options genius. I call him the options god, right? So he's the guy who taught this to me and taught it to all our options students, and it's brilliant. So I'm going to share with you a bit about how it works and how we use it to profit regardless of direction. If you have no idea what options are, do check out my basic option videos on YouTube, right? The introduction to options. So you have some basics about calls and puts. And if you know a bit about options, right, let me share with you a bit about how this works. Now, this is basically a modified double calendar spread strategy. Okay, now it sounds complicated, but it's actually very, very simple. Let's get down to it. So in this strategy, I'm going to create two calendar spreads. One is a bullish calendar spread that makes money if the price goes up, and one is a bearish calendar spread that makes money when the price goes down. So it's going to be double calendar spread. So either way, I'm going to make money on it. Okay, so a double calendar spread is one where you buy an option and sell another option. You buy a long dated option, sell a short dated option at the same strike price. Now the question is, what are the strike prices we're going to use? We're going to use an upper strike price and a lower strike price. So let's decide on the upper strike price. Where do you think the price is going to go in, say, about 20 days, right? Now, we don't guess on these things. We use mathematical probability, all right? So over here, for example, let's take the 21-day expiry. So this expires on the 15th of May, which is 21 days from now. So in 21 days, the market either goes up or goes down, right? We don't know, either up or down. So if it goes up or down, by how much would it move? We look at this probability based on the standard deviation based on implied volatility. Sounds a bit confusing, but it's really simple. Basically, it means based on the market's movement, where should it go mathematically, right? So in 21 days, it should either go up by 191 points, as you can see, plus 191, or it should go down by 191 points. Can you see what I'm saying? All right. So if it goes up, I want to have a target that's within 191. Not exactly 191 because it may not reach there, so I'm going to give a bit of a discount. So I'm going to aim for about roughly 160 points up. Okay. So the current price is 2836. That's the price today. So if I add 160 points, what's my upper target? Roughly it'll be 3,000 on the S&P 500, right? So in 21 days, if it goes up, it may reach 3,000 points based on current volatility, yeah? But if it goes down, You'll also go down by 191 points, but I'm going to give a bit of discount. So say it goes down by 160 points. So my lower target will be 2836 minus 160. That would be about roughly 2670. Okay? Get me so far? All right. So let me repeat what I just said. Okay, so the current price of the S&P is 2836. If it goes up in 21 days, it would reach roughly 3,000 points based on the probability over here. But if it goes down, then it would likely reach 2670. So we've got an upper target and a lower target. We're going to create two calendar spreads. So how do we do that? All right. So all this is automated in brokers like Think or Swim. That's what makes it really cool. Let me create my upper strike first. Okay. So I'm going to look for 3,000. Okay, there we go. Can you see 3,000 strike price? Okay. Now I can either construct with puts or calls. It doesn't matter actually. Whichever is cheaper, I'll take that. So let's construct with puts. Even if it's an upper strike, we still can use puts, right? Bet you didn't know that. So we right click on this and we choose a calendar spread. Okay. So choose a calendar spread. 3,000 is the strike price. I'm buying the 18 May contract and selling the 15 May contract. That's how a calendar spread works. Buy the longer dated one, sell a shorter dated one. Now, what's the price of this contract? It's $2.05. If I use puts, if I use calls, you can see it's cheaper. So I'm going to use calls since it's cheaper. So it's $195. All right. So in other words, to buy this contract, it's going to cost $195. $195. Because one contract is 100 shares, right? So for my bullish trade, it's going to cost me $195. All right, over there. All right. Now, what I'm going to then do is I'm going to click Analyze the Trade. There, all right. Now, I'll go through this in a while. Just hold on. Let me go back to the option chain. Now, the next thing I'm going to do is I'm going to create a bearish calendar spread. So now if it goes down, I'm going to be profitable, right? So the strike price is 2670 now. So I'm going to look for 2670. There we go, 2670. Can you see that? All right. So right click, buy a calendar spread again, 2670. Buying the 18 contract, selling the 15 contract. Again, with puts, it's going to cost $315. With calls, it's going to cost $310. So calls are slightly cheaper. We can use calls if we want to, right? So interchangeable, right? So again, I'm going to look at the price. It's going to cost me $310 for this contract. $310. There we go. So to buy both contracts at the same time, how much is going to cost me, right? 195 plus 310. That will be $505. That's the total cost of this double calendar spread known as Snipex. So the most important question is, how much can I make on this trade? So let's take a look at the profit and loss graph right now. So for this bearish calendar spread, I'm going to also do the same thing. Click on Analyze the Trade. There we go. Okay. So do you see two mountains coming up? All right. So over here, let me just show you that. You can see I've selected the two calendar spreads I've created. Right. So the first one cost $195. Second cost $310. Total cost $505. All right. And the upper strike is 3,000. And the lowest strike is 2670, somewhere over here. Okay, so how does this work? All Alright, so over here you can see the profit and loss chart. On the y-axis, it tells us the profit. On the x-axis is the price of the S&P 500. Okay, so you can see this is the zero line. This is plus $500, plus $1,000, plus $2,500. This is minus $500, minus $1,000. So anything above the zero line, that's making money. Below zero line would be losing money. Okay, so right now the S&P 500 is right at the center 2836, as you can see that. Okay, so again, in 21 days, the price will either go up or the price will go down. Okay, now over here you can see this green line going up and down. That is my profit or loss at expiration, which is the 15th of May. This blue line that you see, or sorry, this purple line that you see is the profit and loss at this date over here. So the date is the 23rd of April, but of course when I put in the trade on Monday, it will be the 27th, right? So I'm going to change it to 27, as you can see, 24th, 5th, 6th, 27th. There we go. Okay, so here's how it works, right? So in 21 days, right? If the S&P goes up to 3,000 points, which is my target, and it happens to be exactly at 3,000 points, during the expiry or on the day of expiry, I could make a total profit, as you can see, of $2,000. Okay, $2,000. So if the market goes up, I could potentially make a max of $2,000. But if the market goes down to the target over here of about 2670, which we calculated over there, I could make even more, right? You can see the green line. I could make a profit, maximum profit of $2,500. So we call this a non-directional trade because it's a trade that profits in any direction. Again, my maximum risk is $500. That's the most I can lose, but the most I can make is $2,000 on the way up, 2.5K on the way down. Now, of course, you may say, what if it doesn't move? What if it stays at the center for 21 days? Market goes nowhere, right? Could you lose money? Yes, you could lose money if you do not manage to trade well. If the market doesn't go anywhere and I leave it to expiration, then I would lose the maximum $505. As you can see, the green line is below the zero line. I get the maximum loss at the center. But of course, that's not going to happen. Why? Now, again, bear in mind, this calendar spread, as it moves towards the expiry, the purple line will change until it becomes a green line. Okay? So again, this is the 27th of April, as you can see, 27th April, right? Now, look, 28th of April, 29th. Now, notice how the purple line is changing. Can you see the purple line is going up? And then slowly it will start to invert and become the green line that way, all right? So I have got 21 days to watch this trade. So let me share with you how I manage to trade. So what happens is, as time passes, the purple line initially will go up that way. Can you see it goes up? Okay. So this strategy is one where it is long theta. What it means that as the days pass, I'm actually making money because of time decay. Time decay works in my favor in a calendar spread. So if the market doesn't move anywhere within, say, about 10, 11 days, what do you think I'll do? That's right, I'll close the trade without losing money, because you can see that the purple line on, for example, the 5th of May is above zero, right? So I'll make a very small profit. I'll make maybe only about $200. Okay, so again, I can only lose money if I hold it to expiration, where the purple line will then, on the 12th of May, for example, start to go below the zero line and it starts to lose money, right? So as long as I get out of the trade before the 12th of May at the center, I won't lose money, All right, so you got to manage the trade, got to watch it every single day, get out the moment the market's not moving. All right. Now, I can also lose money if the price goes up too much. Okay, so if it jumps up way above 3,000 points, then you could see that I could also lose money over there, right? If it expires on the 15th of May, or if it drops even more than 2670, I could also lose money. So it goes up too much, I lose money. Goes down too much, I lose money. So again, what do? The moment the price goes up and exceeds this target over there, I'll close the trade. The moment the market goes down, exceeds this target, I'll close the trade. So I'll never allow the market to go to the extreme ends. As it's reaching towards the extreme ends, I will close the trade for a small profit or break even. So the great thing about this strategy invented by my friend Bang Van is that the majority of the time, all right, I would say it wins 95% of the time. 95% of the time you're going to make money. But there's always going to be a 5% where you don't make money, where you just break even, or even if you lose very little, right? So these are the best kind of trades to take in the market. And this is just one example of the many advanced options trading strategies that we teach to all our students. And that's how we help our students to generate short-term profits regardless of market direction. So it's a great money maker in the market. So you need to be both an investor and a trader. So for investing, we buy great companies at huge discounts. We know in the long run, it will always go up, you'll always make money in the long run. But in the short term, markets are unpredictable. They could go up, they could go down. So why not make money in the short term regardless of direction? By the way, do note that these strike prices and prices I'm showing you are based on last Friday's closing price. But on Monday, when the market opens, I have to reanalyze the entire trade with new strike prices and new prices because things would have changed by then. So this is shown purely as an example. But on Monday, when I actually place the live trade, prices will be different. All right, so just bear that in mind. So I do hope you've enjoyed this short video lesson on the power of using options to profit under any market situation. If you've got questions, send them to support@piranhaprofits.com or check out our courses or our newsletters. In fact, Bam is just coming up with the brand new options newsletter, which you can subscribe for and see exactly how we trade live with all these powerful strategies. So again, go to piranhaprofits.com, find out more about subscriptions or courses, and may the markets be with you. So if you want to be the first to get my next video on YouTube, do click the subscribe button right now. If you want to check out my online courses, go on to piranhaprofits.com where you can enroll in our professional Forex, stock trading, options trading, and value momentum investing courses where you're going to learn how to trade like a professional and generate an income anywhere in the world. If you would like to come to Singapore to attend my live classes, Wealth Academy, go on to wealthacademyglobal.com. It's Adam Khoo, and may the markets be with you.